We are going to move on to our first two presenters. First of all, tuning in from or dialing in from Vancouver, we've got one of the owners of the KB Mortgage team, Keaton Kirkwood, who is also a longtime seasoned investor, and that's why he's on our Mogul team, our power team, as the person we always recommend, because he can truly walk the walk as well as talk the talk. And we also have the owner of the Mogul Realty Group, who is also a very successful investor in his own right, having multiple multifamily investment buildings in Edmonton, I believe just coming up on 300 doors himself. So he certainly is an expert in regards to dealing with multifamily. We're going to hand things over to Keaton Kirkwood and James Knull.
Thanks, Devin.
Thank you, Devin. And hello, Keaton.
Hello, James.
How are you doing?
I'm doing well. Happy
Fantastic.
I get to spend 30 minutes with you.
Oh my gosh, yeah. I've been brainstorming all the best questions all day. So I'm looking forward to picking your brain about one of the most important, but also one of the most intricate and detailed and tricky to understand parts of this whole multifamily game, which is the financing piece. So Keaton, I know that you have financed a whole bunch of investment properties on the residential side, and I know you've financed a whole bunch of properties on the commercial side. And so let's start general, and then I'm going to really get into the specifics with you. So if I was a new client or even an existing client, if I was a client and I come into your office and I say, you know, Keaton, I'm thinking about moving into this multifamily game. What are some of the things that I need to know?
So commercial is one of those interesting ones. I was actually thinking about what I was going to share in this earlier today, and there's a lot of catch-22 answers. Commercial financing can be the lowest interest rates you'll ever get. It can be the highest interest rates you'll get. It can be shorter amortizations than residential. It can be longer amortizations. So a lot of the answers I'm going to give are going to have caveats to them, little star, star, star. So it's important to always make sure that when you're taking the advice that I'm giving, you're making sure it applies to your situation. The first thing I would do with a client, and what you need to narrow down, is what type of commercial investor do you want to become? Because commercial breaks down into gas stations, motels, hotels.
Yeah, you know, and I'll just hop in. We're talking multifamily, so
we'll keep it
let's zoom in on that.
So for the multifamily side, the biggest thing you need to narrow down is where you're investing, when you're investing, and what type of multifamily you're going for. Because, and James will come across this pretty regularly, the really, really good deals usually have issues that you're going to go in and solve. Those issues that make it a valuable deal for you cause trouble with financing. That typically means you need more cash or you need more creativity to solve. So really narrowing down what the investor is looking for and trying to keep the scope in line with the experience.
All right, so I'm gonna get a little bit deeper into one of the comments you made, which is the amount of cash you need available. When we invest in residential assets, the lending package is fairly cookie cutter in the sense that we're almost always putting 20% down. We're almost always going to get the same amortization, which is almost always 30 years. We're almost always going to get the same fixed interest rate, plus or minus an itty bitty bit based on the lender. We're also going to get the same variable interest rate if we go variable instead of fixed, plus or minus a little bitty bit based on the lender. Every single one of those variables can change in multifamily. And so I'm going to add, so the common theme is it depends, but we're going to talk about ranges, and like I want to get into some of the things that it depends on in this conversation to help people get that first glimpse of what's happening in multifamily. So let's talk about that initial cash amount. You know, if you look at a single family property, it's like we need 20% down. Simple math, 0.2 times price. Ta-da. What amount down or what range of amount down do we normally look at in a multifamily, and what determines where in that range we are going to be?
So the first fork in the road we're going to face is if it's CMHC insured or if it's not. CMHC insured means that it's 5+ units, that's multifamily, and it has to be at least 70% like tenanted property. So if it's a mixed use space, there can only be 30% of like hair salons or whatever. CMHC caps out for buying an existing property at 15% down. That's your best case scenario. On top of the 15% down, you're going to be required to have funds to carry the project. They want to see that you have some sort of fallback. Typically, that's usually a few $100,000. They want to see that you can basically carry the project for about 6 months if there's bad news. Conventional financing, which is not CMHC insured, is typically going to require anywhere from 25 to 35% down, but that can once again swing very much on the lower side where you can need larger down payments. Either type of lender though, whether it's insured or it's going directly to a conventional lender, they're going to base that off of the performance of the building as is relative to the purchase price. So that's going to be the cap rate. And they're going to look at what's called net operating income.
All right, so we're gonna pump the brakes there for a second because you're using terms that I want to make sure we take a minute to explain. But I'm just going to reiterate. So there's a range of the amount down that the bank is willing to give you. And one of the things it depends on is just the bank's perception of risk. And the best way for that bank to mitigate risk is to have you as the borrower put more cash down. So, that's going to be, I think, and Keaton, feel free to chime in, but I think that's going to be a common theme is if the bank perceives either you as a borrower or the performance of the building as potentially, or the location of the building or the age and condition of the building or some combination of those factors as riskier, they're going to mitigate their risk by either asking you for more money down or potentially charging you a higher interest rate. So let's circle back to some of the terms that you use, because the bank is going to lend you a percentage of what the bank perceives the value of the building to be. And
that value is perceived based off of the income the building produces as opposed to its numeric value.
Exactly. So let's flush that out a little bit further. When it comes to perceiving the value of a building, in single family, it's all based on what we call the comparison approach. If the neighbor sells for 500 and the other neighbor sells for 500, you're pretty sure to be in that 500 range. Whereas in multifamily, to value a building, we use what's called the income approach. Very, very different. So we talked about net operating income. We use the term cap rate, but can you really flush out what we mean when we say income approach and how that creates the building value? Because understanding that is so critical before we can even really get into financing that building. So
if someone has a building for sale, they had to come up with a number. Let's say it's listed for $1 million for simplicity's sake. There's one would hope that they're not just throwing darts at a board to come up with that value. What typically happens is for every region and every type of building, there's a preset number that fluctuates based on, it's just like looking at the stock market. There's certain metrics we can use to determine rough valuations. In commercial real estate, it's called the cap rate. And that is the multiple of what someone will pay for income after expenses on a property. So hypothetically in Edmonton, what are you guys sitting right now for cap rates on the commercial side, James?
Let's say 6-ish for somewhat decent multis.
So that means in Edmonton, for a building that produces $10,000 in income after operating expenses. So that's not debt. It's not improving the building, like redoing the roof or major expenses that are improving the infrastructure, but rather day-to-day costs like utilities, property management, minor like yard repair, anything like that. At a 6 cap rate, a buyer would pay on average $166.6 thousand per $10,000 of net operating income the building produces. Now these numbers fluctuate based on other things, but that's the general view the lender's looking at.
Right. And the prevailing cap rate is really a number that indicates the perceived strength of the market. And so, if the cap rates in the market are low, it means it's a very secure market. If the cap rates are high, it means the market is a little more volatile, a little more risky. So just to reiterate what Keaton is saying, we really want to understand that the building value is really a function of the profitability of the building as compared to the strength of the market that the building exists in.
And the best way to visualize cap rates is to think of a tug of war between buyers and sellers. Obviously, buyers want to pay less So they want more value for less money. Sellers want to give less value and receive more money. The cap rate is kind of, think of the middle of the rope they're tugging on. The sellers want more, the buyers want less. The cap rate's indicating kind of the average. What is the norm for the market when people review and negotiate? What's kind of the average that people usually settle on? And then all the factors outside of that are going to influence it one way or the other.
Got it. Got it. So, okay. We're now we're really starting to wrap our head around this thing, because when you approach a building as a potential buyer, your buyer's agent will talk to the seller's agent, and what they'll rustle up for you is a statement. Typically it's like a 1-page summary, pro forma, as we say, of the building. And on that pro forma will be a net operating income and a cap rate. So that's kind of your first starting step. Now, Keaton, you and I both know what a selling realtor may advertise and what the actual building performance is in reality can be quite different. So talk us through what happens when, myself, the enthusiastic investor, says, Keaton, I've got a pro forma on a building that I like. I'm thinking about putting in an offer. I want to buy it. Let's talk about financing. Ba-boom, here you go. What do you do next to objectively and intelligently move this conversation forward?
Rip that piece of paper up to start. 95% of the time, they're not very accurate. So what we usually do is we work with the client to make sure
I'm sorry, I'm going to pause really quickly, because I think that's a really key takeaway, is that they're not very accurate. But how,
really
where are some of the, like, how and why and where? Let's talk about those inaccuracies for a second. Because if you're out shopping, if you call myself or Adrian up, the two commercially licensed realtors on the Edmonton team, or myself or Eric up on the Vancouver team, and say, hey, 70-40 pro formas of 40 properties, you're going to have 40 inaccurate documents. Now, why and how is that the case?
Well, the first thing to realize is that everyone has a bias. Now, when Johnny Seller wants to sell his building, he has an expectation that his realtor is going to move mountains and earth and get the highest number possible. So there's a bias and a pressure on the realtor to present a higher valuation.
Mm-hmm.
On top of this, there's often many sellers don't understand how the net operating income and debt coverage ratios work. And they don't understand that if the owner is putting in 40 hours a week, let's say, to manage the building, and they're putting sweat equity into the financials, essentially, they're trading their time to reduce costs in the building. That's a perfect example where net operating income can be skewed due to, whether you want to call it mismanagement or misunderstanding of the way it's going to work. Because when you, as a buyer from wherever in Canada, purchase the property, you don't have the luxury of Johnny owner putting 40 hours a week in to do the grass and to cut costs. So the way that we get the true NOI is usually after writing the offer, and we have to go through the financials and build the numbers out. And it takes a lot of time, and a lot of sellers don't do it, or they misunderstand it, or they have obviously a bias to get a higher number.
Yeah, exactly. So, the selling realtor is, as we do, we'll get our high, like in the residential space, we get our high resolution camera out with the wide angle lens, and all of a sudden that kitchen looks pretty big. In the multifamily space, the numbers get massaged a little bit to have that building look like it has a much higher value for advertising purposes. So now let's get into the brass tacks of it. We've got a pro forma. We're starting the initial conversation about financing. So let's circle back to that comment. So we're obviously not going to rip the pro forma up, but we're going to look at it with a skeptical and objective eye, looking for where those numbers may have been embellished, as we say. So what are you looking for in that pro forma, and how are you starting the conversation with the multifamily investor client that you're now sitting down with to talk about the building?
So generally, pro formas will have a gross income, and they'll show a little bit of a rough breakdown of expenses. Now, it's going to depend on the depth on this. But as an example, if there's a 4-story apartment building and it has an elevator, and we don't see any specific line items for elevator maintenance, and we notice that the general maintenance is in line with the building without an elevator, and this ultimately comes from experience, we may notice, looks like there's expenses missing in certain areas. And we can use norms for a building based on its age to assess the operating expenses. As a general rule of thumb, you're going to see at least 30 to 40% of the gross revenue used as an operating expense.
So I'm just gonna hang on that one right now. So if you see a net operating, if you see gross, which means before expenses, the total rent all added up, in the ballpark of 30 to 40% is what the expenses should be. So for those of you who are kind of just looking for some of the golden nuggets in this presentation, if you look at a building and it's either way lower than that or way higher than that, it's a reason to stop and think, what the heck is going on? Sorry to interrupt, Keaton, but that was a really great point. I didn't want to let it go unnoticed. Keep going.
No worries. So what we're looking for is, are they being really optimistic? And once again, if a building's 1 year old and it's built to the highest efficiency standards and it was built by someone with experience in this industry and they really knew how to stretch things, maybe a 22% operating expense may be reasonable. But if the building's 25 or 30 years old, it's probably not something you want to believe. And I personally use the performas as just a rough ballpark of, is this building or is this property in line with what you're looking to acquire? And we, at least I personally lean towards the initial price you write your offer for means nothing. It's a token of good faith that you're willing to pay fair money for fair value. But the reality is that once the offer is accepted, and I won't delve into this because I think we'll touch on this a little bit later, but we're going to get a lot of paperwork from a seller and we're going to go through everything and we're going to come up with our own numbers.
So, you know, the process that you're describing is called underwriting, where you put together a budget for the property based on the information that you've been given from this pro forma. And then you're going to take numbers that buildings like the building we're looking at typically produce if there's a discrepancy. So for example, if there's no property management line in the pro forma you've been given, well, when you underwrite that building, you're going to add in a fairly industry standard property management number, for an example. Or if there's no repairs and maintenance that have been claimed on the pro forma, you're going to toss that in there as well, right? Then that's going to give you a idea of what that building's value should be, number one. But number two, at this point in the conversation, are you able to give any kind of a ballpark of what a financing package on a building like that could look like?
Yes, we're able to take usually things are going to get worse, not better, off the pro forma. So we can take the pro forma and say, if this stands correct, a lender is likely to lend X dollars on the property.
Yeah.
The way that works is they take the net operating income. So we'll say, for simplicity's sake, it's $12,500 per month. A lender is going to look at it, and if they're using a 1.25 DCR or debt coverage ratio, it means they want to see $12,500 in income for every $10,000 of debt they'll give you as an expense. So then we can take that number, plug it into a calculator and reverse engineer. Oh, that equals whatever, $300,000 in debt you can take. So that we can provide rough ballparks at the preliminary stage based on that net operating income.
Right. So if I take that idea a step further, if the debt coverage ratio or the DCR needs to hit 1.25 and the building value is a little out of whack, then the way that we can achieve that is just by putting more money down.
Yes. If the building is valued beyond what the income can support, you as the buyer have to come up with the difference.
Yeah. So that's an interesting little parcel of what goes on in the multifamily world. Is sometimes what you as the buyer are willing to pay and what the seller is willing to sell isn't the same as what the lender is willing to lend on. That happens. And then you get to make a decision of, well, do I just want to put a little bit more money down to get a financing package that gets me an interest rate that I'm happy with? Or is there an option to just pay a slightly higher interest rate to get the deal to where it needs to be?
So I will add, it's very common if hypothetically you're an investor and you call up James and you say, hey, I'd like to buy a turnkey multifamily property. And James happens to say, hey, I've got one in my portfolio. We're interested in selling it. And James has tuned this thing up. He's made it as valuable as he can. He's bought it from someone else and eliminated all the inefficiencies and the mismanagement. That's a building that you're going to get good, favorable financing on right off the bat. But if the investor says, James, I want a great deal. I want to buy a property. I want to put work into it. I want to make money. That's a situation where we're probably not going to a major bank for your financing, or at least we're only going to the bank for part of your financing. Buildings that have a lot of value add opportunity typically are underperforming, and you're going to come in and increase the performance. That usually means we have to close with private financing, or at least a combination of bank and private financing. You spend 1 to 2 years repositioning the building, so fixing the problems, getting statements on the financial side that show you fixed the problems in the new revenue, and then we can reposition the loan, pull out equity, pay off the private loan, and that's when you end up with the good long-term financing. So it's usually a sequential approach on the commercial side.
Yeah, that's, and you said that all pretty quick, but that's also one of the most appealing and exciting things that can happen in the multifamily game. So I'm gonna slow it down. I'm gonna re-articulate it, and then we're gonna unpack that little piece because it's a great piece. So as we know, the value of the building is derived from the income the building produces. Now, if you can find a way to increase the income of the building, you can find a way to increase the value of the building. And once the building's value is increased, then you can redo your financing package or refinance the financing on the building and take higher interest loans that the bank perceives as riskier and flip them to lower interest loans. So Keaton, explain what that process looks like, because everybody hears about, if you listen to I've been on podcasts where I've talked about this because we've done it in buildings where, we'll get in there, we'll buy a building that performs poorly because it's either got poor tenants, poor quality of building in terms of renovation, it's been poorly managed, and you go in there and just like you said, you spruce it up, you improve the building in a bunch of meaningful ways, and then we can redo the financing. So walk us through that. So let's say, I come to you and I'm like, Keaton, this building needs a lot of love. I'm buying it, for a high cap rate. I'm buying it for a low price, and it's gonna cost me a lot of money to renovate it. Can I get a loan for some of the cost of the renovations? What does that look like? Like, what does that initial financing package look like? How do we get it approved? What are some of the interest rates that are prevailing in today's marketplace?
So there's two routes, and this is going to depend on the asset. There's the scenario where, I guess there's three scenarios. One is that we're able to get bank financing on the property as a temporary solution, and this would be a client with deep pockets. Maybe they get 50 loan to value, so 50% of the purchase price.
Mm-hmm.
The next scenario would be we would get maybe 50% loan to value from a major bank, and we get what's called mezzanine financing, which is essentially like a second mortgage with a private lender to top up. Maybe it brings you up to 65 or 70% loan to value. The third scenario would be, let's say it's a really terrible building in the sense that it needs big work and it's fully vacant and it's not doing anything, and you see dollar signs but the bank sees risk. In that scenario, we'd probably have to go fully private. So we would look at the building, and those rates are going to range. Major bank, like if you go to TD and you get a commercial loan that's not insured, you're probably looking at rates in the mid threes. Could be a little lower if they like you, could be a little higher if they don't. For a fixed rate. Variable rates typically prime plus 2.5. Once again, varies. It's important to note it and write this down. The larger the loan, the more the bank wants the deal. Commercial financing is very much a size matters game. Mortgages under $1 million are difficult. Under 500,000 are very difficult. Under $250,000, I'm buying people dinner to get them to take the file. It's almost bribery at that point.
Right.
So it is important to note that the deal size really does matter and how much appetite a lender is going to have. They care less about you as the borrower and more about the property and the size of the debt.
Got it. That's a very, oh gosh, there's so much, there's a lot there. The first thing I'm gonna touch in on is a lot of people tiptoe into the multifamily game saying, oh, I want to start with a 6-plex, an 8-plex, a 10-plex. And I always tell people, multifamily is about economies of scale, and there's no scale with a tiny building. And so another place that scale exists is the quality of the loan that you can get. Because from the perspective of a lender, placing $1 million versus placing $3 million, it's not any more work to place the 3 million, but they get 3 times the return on the investment because they've replaced 3 times the funds. And so it's more efficient for them, more appealing for them to do that. So these scrappy little teeny tiny buildings are often not what they're cracked up to be. So I just wanted to observe that you mentioned that and tee in, like, multifamily is about economies of scale. You're not getting scale usually sub 12. So very, that's just a side tangent point, but be very cautious about if you're going to jump into multifamily, go big-ish at first. Yeah. Anyways, so let's talk a little more about the refinance piece. So what thresholds do you have to hit? Like what, I've got into this building. I've probably submitted a business plan of some sort to the lender. Now, how, when, and where are we refinancing? How do we trigger a refinance, et cetera, et cetera?
So typically, hypothetically, you buy a property, it's probably going to take you at least 90 days to fix the issues. Unless it's a case of, they haven't increased the rents in 3 years and you've got the ability in Alberta.
I mean, I'm just going to jump in. It's going to take 90 days would be
optimistic.
Yeah, we're talking, like, I'm thinking 12 months because especially, I mean, depending on what province you're in, turning over tenants is very, very challenging in most markets outside of Alberta. Sorry, continue.
There's a reason I invest in Alberta, James.
Yeah, well, yeah, that's another discussion, but yeah, no, go ahead.
Hypothetically, it's going to take 90 days. Maybe it's going to take 6 months, but it's going to take a period of time to fix the issues. So that's phase 1. So you're going to buy the property. We're going to go into phase 1, which is fixing things. Once everything's fixed, we're going to have new tenants in. There's new revenue. The building is now performing as we want. Phase 2 is stabilizing things. So hypothetically, for another 6 months, we just let it run. At that point, we can get an accountant to prepare interim financials so we can put numbers.
So let's pause.
In the building.
Why does the bank care that it's been running for 6 months? What does that matter to the bank? Why is that a thing?
Because investors are crafty and simply waving a bunch of leases in front of the bank's face that show, oh, we increased the rents, don't fly. So the bank wants to see, at an absolute minimum, 3 months proof of the revenue. As an industry standard is closer to 6 or more. Once again, going to depend on the relationship, the deal, the building. There's a lot of variables that go into this.
Yeah, and that's I just, again, wanted to pump the brakes on that because the banks have watched investors jump through loopholes for a very long time, and so they slow things down too to make sure that like, they want to see money coming into your bank, not just a lease saying that it might. So that's a great point. So okay, we've hit some of our thresholds. We're refinancing. Everybody's heard a story in a podcast about somebody that pulled a whole big pile of money out of a building. Does that happen frequently, or is it more so you just refinance with a better financing? Like what usually happens? What's pretty typical across Canada from some of the loans you've placed in the last, say, 12 months?
I would say that it's realistic to pull out additional funds beyond the original mortgage, but the idea of buying commercial assets with no money at the end of the day is extremely rare. There's a lot of misinformation out there. The reality is that buying an underperforming building could be a blank check. You could, the moment that James gets you the accepted offer, theoretically, you could have made $1 million. It hasn't happened yet, but if you're a sophisticated investor and you know that there's a term that's often used called lease to loss. Hypothetically, there's a bunch of 2-bedroom units. They're renting for $1,000 a month. James and the property manager go, hey, these things are worth $1,500. The property manager was asleep behind the wheel. They didn't increase the rents every year. They just don't realize what they have. If you were able to increase your rents hypothetically by 50% in Alberta, you take over, you give the notices, a couple tenants leave, rest pay it. Hypothetically, that would be a scenario where you could pull a lot of money out right away. But think critically as an investor. If that deal is just sitting on MLS and the first person to look and go, are these things rented under what they could be? And they do quick math, and yes, it's that property is someone's able to calculate out very quickly what it's worth after they fix the issue. It's going to be very, very competitive to get that deal.
Mm-hmm.
So I find that the average commercial deal is usually scrutinized. If you're the first set of eyes to see it, it's the best opportunity. So unless you're bringing a unique skill to the table, maybe you've done a ton of research on solar panels and you've got this really cool niche. And that's what I like about commercials. You can develop a niche, but unless you've got something unique you're bringing to the table, if you're going to do everything you've learned in all the different investing groups of, insulate the property, put new windows in it, increase the rents, put coin laundry in, the basics, odds are if 5 other people have looked at that building and you're the 6th, you're going to buy the property, you're going to reposition it, you're going to pull a little bit of money out, you're going to have a good long-term asset that's going to provide income, is going to increase in value, but you're probably not pulling $400,000 out on top of your purchase price. It's just probably not going to happen.
Makes sense. Now, I wanna shift gears to help people get prepped for buying one of these things if they want to buy it. So, we're talking probably 25% down, maybe 30% down, depending on how the building's performing. But this is where I'm going to throw you under the bus as a broker, but people need to know this. When you buy residentially, the bank pays the lending fees, the mortgage broker fees. Mortgage brokers do work, they get paid for their work. Newsflash, that shouldn't be a surprise to anybody. The work that the lender and the mortgage broker does in commercial gets paid by who, Keaton?
By the borrower.
By the borrower. So not only do you need your 25% down, but you're going to need to have some extra cashola kicking around to pay for the mortgage broker fees, the lender fees, and here's the real kick in the old butt, the legal fees of the lender. So what does that all add up to, Keaton? Give us a range.
So the lender fee and the broker fee can be built into the interest rate with some loans. So a 1% fee is going to increase a 5-year loan by 0.2% per year. So sometimes there's an option to build it into the interest rate. Sometimes there's not.
And so what's the range of the fee though?
So fees, the smaller the deal, the higher the fees typically. Like a $200,000 mortgage may have a 3% fee. So it's all percentage based typically. Normal size loans.
Say they were borrowing $2 million. $2
million, you're probably looking at a lender fee of 10 to 15,000. You're probably looking at a broker fee of 5 to 10 grand. It can vary, depends on the deal, but it's a rough range.
Yeah. 20 grand. You got to pay it. Good to know. And instead of getting salty about it, just budget for it. Like that multifamily is a more expensive game to get into. That's why you want to have those economies of scale. You're paying 3% fee on that teeny tiny little building, whereas you could be paying a 0.5% to a 1% fee on that big old building. Much more efficient use of your capital. And do you happen to have an idea of what the bank's legal fees are going to be to place a loan?
Typically, you can expect about $4,000 for legal fees all said and done on a commercial deal. Be a little bit lower, can be a little bit higher, but I think if you budget at the high end of the average, it's always a good place to be. Because you're prepared for things usually end up a little more expensive than you think. But you also want to have a realistic expectation so you're not getting ripped off.
Yeah, of course.
We should touch on the due diligence costs at some point too, James, because that's a whole nother can of worms.
Well, I think our main man, Adrian, who's going to get into an introduction to multifamily investing, is going to talk about that fun
Perfect.
little piece of the pie. So I wanted to keep it really on the banking end with yourself, because, you know, what typically happens when you want to buy residential investment assets is you go and get pre-positioned with your investment oriented mortgage broker. People come to you first. That's what they should do. Whereas on the commercial end, they can come to you for an explanation of how things work, but because the loan is so building dependent, the conversation doesn't really start until there's at least a building to look at. And that's a very, very important mindset shift. So that's why I wanted to talk to you about some of the intricacies associated with borrowing in a multifamily setting, so that the conversation that you would have with a client that's sitting down with you the first time, we just had that conversation, and it's a great conversation to have. So the next step for someone that's seriously considering multi is to grab that pro forma and start playing around underwriting with you. Is that a fair statement?
It is. So our process is, if a client comes to us and says, I want to buy a commercial building, we do a little bit of a pre-qualification, because we can use normal, like general metrics for a market. It's important to know that the number one priority with the lender is the building. The mortgage size is kind of a second consideration. Your net worth's the third. Your credit and experience is the fourth. Your income is the fifth priority. So what we like to build out ahead of time is the experience and the net worth. So because there's lots of angles to be had in this type of stuff, where we can, the commercial lenders look at net worth from a common sense standpoint. It's not like residential financing, where if it's not a stock or a security or a bond, they don't care. Commercial financing will look at the value of your business, your collector car condition, or I can't speak today, your car collection. They will look at the value of real estate. They will even look at debt you can access, like a HELOC, as liquidity. On top of this, the experience piece is really, really important to the lenders. So if you have a lot of real estate experience, we can put a bio and a presentation together for this that will really help get the deal done. Yeah. Or we can help you work with your team and highlight who's working with you and who's helping guide you through this.
Got it.
And these are things that if you just walk into your bank and you say, I want to buy an apartment building, and you've never done any of it before, the bank rep might not do that. And if they don't do that, underwriting and risk is going to say, oh, they own their home. They've never managed anything before. Yeah. And you're going to get declined based on experience.
Totally. Well, Keaton, those are great tips. Now we're going to head into the networking break. And if you want to network with Keaton, Jen, what I'm going to say is maybe let's leave Keaton in the general room. And then if you want to ask Keaton questions, hang out in the general room. Otherwise, if you want to network with your fellow investors, stick to your breakout room. So Jen will toss everybody into a breakout room.
And James,
then, yes, sir, Devin.
Just quickly before we get into this, there are a few questions that are financing related or certainly topical to this. So, percentage that commercial agents charge in Alberta and in BC. Are you able to answer that, James?
I thought that was directed to Keaton. The range, I mean, the range is like 0.5% to 3% from what I've observed.
Okay.
Keaton, is that about right?
I would say it's relatively normal. Bigger deals are a lower fee.
Yeah, I mean, don't walk into a mortgage broker asking for $1 million expecting to pay 0.5. Like those are the big daddy loans where it gets that cheap.